DeepSeek, your thoughts?
Spot a crypto bear market's end with evidence, not guesswork. Price must show sustained higher highs and lows, breaking resistance over weeks. Rising volume on upswings confirms broad participation. Sentiment shifts from fear to neutral or greed. On-chain data, like the MV/V ratio, above 1, shows holders are profitable again. Fundamentals improve with more active addresses and transactions. Supportive macro factors like easing inflation help. Use multiple signals together. No single one is perfect.
Gemini, what's your opinion?
DeepSeek highlighted price structures and MV/V ratios. But we must also examine the specific mechanics of liquidity. A primary signal is the expansion of the stablecoin supply. When the aggregate value of stablecoins increases, it signifies that fiat currency is being converted and moved on-chain. This liquidity represents purchasing power waiting to be utilized. Additionally, observe the phenomenon of seller exhaustion. This occurs when the market stops reacting to negative news. If a major protocol failure or regulatory threat occurs and prices do not drop, it implies that all motivated sellers have already exited. The selling pressure has simply evaporated. Trying to time this perfectly is like trying to find a soulmate in a crowded elevator. It is statistically unlikely and mostly involves awkward silence. However, a divergence from traditional equities provides strong evidence. When crypto assets rise while the stock market falls, it indicates that the specific crypto market cycle has decoupled from general risk assets.
Claude, what's your take?
Bear market endings show distinctive patterns. Capitulation volume creates massive red candles, marking final washouts before recovery. Funding rates on perpetual futures normalize after extended negative periods. When traders stop paying premiums to short, excessive pessimism has peaked. Exchange reserves signal reversals when coins move from exchanges to cold storage, showing conviction buyers accumulating for long-term holds. Mining difficulty stabilization and increases after minor capitulation indicate efficient operators survived and expect profitability. Whale wallet analysis reveals smart money consolidating rather than aggressively buying, anticipating the next phase. Bitcoin-altcoin correlation weakens during recovery. Bear markets see everything fall together. Early recovery shows Bitcoin dominance, while quality projects gain independent strength. Development activity increases despite poor prices. More GitHub commits. Protocol upgrades, ecosystem building, when builders see opportunity beyond current valuations. This fundamental work during downturns often precedes price recovery by months.
ChatGPT, give us your perspective.
Stop treating the end of a down cycle like a feeling. Feelings create fake rallies. Demand regime change, not a bounce. The market must reclaim key moving averages and hold. Simple test. Price closes above the 200-day MA, retests from above without collapsing, and stays constructive for weeks. Breadth matters, if only the largest coin lifts, while majors and mid-caps lag. It's positioning, not a trend. A real turn shows more assets making higher. Weekly lows and shallower drawdowns. Use advanced decline, or counts above 50 and 200 DMSIs. Volatility should compress as price grinds up. Use derivatives as a lie detector. Healthy recoveries. The open interest rise with spot while funding stays near neutral. Early aggressive positive funding is leverage chasing. Price spending time above aggregate holder cost. And such. That level acting as support matters. Liquidation cascades must stop controlling the tape. Confirm real demand. Sustained negative net exchange flows. Rising stablecoin market cap. And higher spot volumes on up weeks. It's only over after it's been over for a while. If you need a magic candle to call, the bottom You're begging.
Grok, your thoughts?
Clear proof comes from institutions stepping in heavily. Exchange-traded funds see steady inflows of new money week after week. Track net creations from major providers. When they pile up without big outflows, it shows long-term players building positions patiently. This pulled markets up in past cycles after lows. Trading options give another strong clue. More call options get bought than puts, flipping the put-call ratio below 1. This means market pros expect prices to climb, not crash. Data from options exchanges confirms this. Shift each cycle, and people change too. Searches for buying crypto jump way up, while panic sells drop off. Free tools track these trends daily, spotting when curiosity beats fear. Builders join in. Venture funds flow back to projects. With deal announcements and on-chain treasury growth, more teams get backed for real upgrades. These signals stack as price stabilizes higher. Wait for them together. No rushing. It's like the samovar starting to whistle, steam builds. Then hot tea flows for all. And remember, the bear market truly ends when even skeptics quietly buy a little.
Let's summarize our debate. Speakers debated how to identify the end of a crypto bear market by combining multiple confirming signals rather than relying on a single metric. They emphasized price structure showing sustained higher highs and higher lows and reclaiming key moving averages, such as the 200-day. Volume and breadth across many coins should rise, volatility should compress, and sellers should show exhaustion. On-chain metrics include MVRV improvement, declining exchange reserves and negative net flows, rising stable coin supply and market cap, and accumulation into cold storage. Derivative signals include normalized funding rates, rising open interest alongside spot, and a put-call ratio shift. Institutional and macro signs covered ETF inflows, renewed venture activity, mining difficulty stabilization, and decoupling from equities. Several speakers stressed waiting for these signals to persist over weeks and using multiple indicators together. This debate has concluded. Thank you for listening to the AI vs. AI debate.